Okay. The next paper is Best Short. The presenter is Pasquale, Della Corte, and from Imperial College. Pasquale is yours.
Can you hear me? Perfect. Okay, so thank you very much for adding this paper to the program. So I understand that this is the last paper of today's session, so I'll do my best to make it short, as the title suggests. So my partners in crime on this paper are Robert Kosowski and Nick Rapanos. So Nick is in the audience, and he's gonna get all the tough questions. All right, so let me set the stage for this paper. So during the global financial crisis that we had in 2008, a number of regulators around the world, they stepped in and they introduced a restriction to short selling. And the idea was that short selling is often seen as a source of price distortions. However, recent literature shows that this measure actually failed to support security prices. They failed to improve market quality in terms of liquidity and price discovery. And this might be in line with the view that short sellers have access to valuable information, and once you limit their market participation, this will have an impact on the information efficiency of prices. So as an alternative policy tools, a number of countries have sought to introduce greater transparency. In this respect, European countries have taken the lead, and they have recently adopted a uniform regime that requires short sellers to immediately disclose their net short position whenever they cross a certain threshold. So this makes detailed data on individual investors' net short position, timely available, and this information goes beyond traditional measures of short interest that a number of academics have used in the literature. So what we do in this paper, just like in a nutshell, so we exploit granular information that you can extract from net short position at the investor stock level. So we have a large data set that includes up to 1.7 million of a publicly disclosed net short position. These positions come from roughly 600 investors and cover up to 1,400 stocks for European stock markets. So one of the things that we observe is that short sellers tend to have bets on few selected stocks. So in other words, they tend to concentrate their portfolios on few stocks. So we hypothesize that there could be high conviction towards certain stocks. So we try to extract through an aggregate measure of investor short conviction, forward-looking expectation about future asset valuation. So what we find in this paper is that if you build up a simple long-short strategy where you sell high conviction stocks and then you buy low conviction stock, then you can generate a sizable excess return. And we call this strategy the best short. And then we've tried to rationalize this excess return. However, we fail to link this excess return to traditional measure of risk, stock characteristics, transaction cost, market friction, and measures of price efficiency. Now, there is a vast literature on short selling, which I won't have time to review. I should mention that we are not the first paper to investigate these new data sets. There have been recent papers by Jones, Reed, and Waller, or there are a couple of papers by Young and Esmail-Belovich. Anyway, so now let me tell you a bit more about these disclosure rules in case you're not familiar with these regulations. So since 2012, European Union has been concentrating on reporting obligations. So investors, regardless of their domiciles, are obliged to disclose net short positions on stocks traded in European venues. And this disclosure applies whenever this position cross certain thresholds. Now, the net short position is calculated as difference between short and long position, and it also includes delta-adjusted derivatives. Now, these disclosure rules works on a sort of a two-tier reporting system. So there is a confidential notification that applies whenever the net short position crosses 20 basis points of the issued share capital of the target company. Then when the net short position crosses 0.5%, then the regulator, okay, will disclose publicly this information. Now, this position must be disclosed within 24 hours by the short seller, and then the regulator will make this data available typically by the end of the next following day. So we got this data from Caretta data, even though you could collect manually the data from the websites of the national authorities. So we have data that span between 2012 and 2018. And as I said before, we have roughly 1.7 million of net short position disclosed by a large number of investors for a large number of securities. And then what we've done, we've matched this data with the traditional European security lending data that you can obtain from market. So typically from market, you can get the number of shares borrowed, the number of shares that are available for lending. You can have information about the expected borrowing rebate rates, the short interest, so on and so forth. Then we have additional data that come from Bloomberg and the Ken French website. Right. So now let me give you just a bit of flavor, a bit of flavor about the data. So here we have all the countries that we have in our data set. As you can probably guess, the largest number of disclosure come from the usual suspects. So you have, for example, UK that account for 38% of the security. You have Germany, 13% of the security, or you have Sweden that accounts for about 10% of the security. Now, some of the countries are missing from the Caretta database, and as far as I understand, they do not collect data from countries that have infrequent daily disclosed positions. Now, the first question that you might have is, whether our sample is representative, because we only observe positions that cross 0.5% of the issued share capital. So one of the exercises that we do, we compare our data with respect to the total short interest. So we construct for each stock in our sample the ratio. Then we take the median within each stock market and then the median across all stock markets. And as you can see here, so we capture a large chunk of these net short positions. So at the beginning of the sample, we are about 60%, whereas towards the end of the sample is larger than 80%. So we believe that our set of data is quite representative. Now, in terms of investors, so we have in our sample asset managers, we have banks. However, most of the daily net short position are associated with the hedge fund manager. So as you can see in our data, 81% of the daily positions are associated with hedge fund managers. And in this paper, we're going to focus on the net short position of hedge funds. Okay, we're going to use the holdings of other investors in the robustness. But as we are going to argue in the paper, there is no information that you can extract from other investors. So, in this paper, we mainly focus on the net short position of hedge fund manager. And so this is just an illustrative example. For example, here we have a Carillon that collapsed in January 2018. And as you can see, we have 40 hedge fund managers that have built net short position on Carillon prior to its debacle. Right. Okay. So what is the first fact that we document here? So we find that managers in our sample tend to have a small subset of short positions. So we find that more than 40% of the managers have a single disclosed net short position, and up to 70% of the managers have up to 3 disclosed net short position. Okay. Now, you might think that this could be an artifact of the data because there is a threshold of 50 basis points. However, there is a literature in mutual fund that documents that mutual funds tend to have basically position concentrated on a few subset of stocks. For example, there is a recent paper by Anton, Cohen, and Paul, and they document a similar pattern for mutual funds. Okay, so also mutual funds they tend to concentrate their bets on a few stocks. Okay, and so what we want to do here, as I said in the introduction, we hypothesize that short sellers have high conviction on a few set of stocks, and so we want to infer their forward-looking expectation. And we're going to use a very simple setting to motivate our measure of conviction. For example, assume that the investors have mean variance preferences. Obviously, they can allocate their portfolio by solving the usual objective function. So we know in closed form what is the portfolio weight. Now you can invert the portfolio weights. In this case, you can have that the expected excess return as a function of the conditional covariance matrix and the portfolio weights. So now what we're going to do, we're going to impose a couple of simplifying assumptions. So the first one, we assume that the conditional covariance matrix depends on a single factor. Okay, so we are going to basically decompose this omega as a function of sigma. So this is a diagonal matrix, and then you have an additional component that depends on the variance of the market index. And then we assume that each investor has a market neutral strategy. Well, we have hedge funds, and we know from the literature that hedge funds, they tend to basically build strategies that are neutral with respect to the market index. So you can basically get rid of this second component in the solution. And so now you find that mu, the vector of expected return, is a function of the idiosyncratic variance on each stock and is a function of the portfolio weights. So by combining these two assumptions, what you get is that the portfolio weight of investor I on stock J is actually proportional to the subjective expectation of the information ratio. So you can think of our measure of conviction as a proxy for the expected information ratio of each manager on a selected stock. So now let me take you to what we do in our paper. So we construct a measure of short conviction of investor I in asset J. So we take the dollar value in asset J divided by the overall portfolio exposure of the investor, and then we aggregate these short conviction across all managers. So in this way, we have a measure of conviction for each stock. We do something super simple. Now, this measure, obviously, you might expect that this measure might tend to overweight small funds, or might also overweight some highly specialized funds. Okay, so this could be funds that have limited resources, maybe higher cost of acquiring information, and that's why they select on a few selected stocks. However, it's worth to mention that there are a number of papers in the mutual fund space finding that mutual funds that deviate from a well-diversified portfolio, so they concentrate on selected stocks, they typically outperform other type of hedge funds. So this is a paper by Kacperchik, Sian, and Zheng. However, there's also a theoretical work by Van Nieberg and Welcome, so where they find that an investor who collects the information first will tend to have an under-diversified portfolio. So he will tend to concentrate his portfolio on few selected stocks. Okay. So now let me show you our second result. So now we construct a long-short strategy, and in portfolio one we have stocks with low short conviction. In portfolio 5 we have stocks with high short conviction. And then what we do, we sell stocks in portfolio 5, we buy stocks in portfolio 1, and this basically constitute our best short strategy. And in our sample, before accounting for cost, this best short strategy generate an excess return of 8% per annum. And this best short strategy is different from traditional short strategy. In this case, we refer to the naive short. A naive short is a strategy where you are long the T bill and then you equally sell all stocks for which there is a net disclosed position. So in this case, such a strategy would deliver a negative excess return of 3.7% per annum. Now, the first type of explanation is to check for risk exposure. So we take our conviction sorted portfolio, and then we regress against the 5-factor Fama French plus the momentum factor. But as you can see from our exercise, we find that the best short, so the risk-adjusted excess return on the best short is still large, it is still statistically significant, and the same happens for the portfolio 5. So basically, the positive risk-adjusted excess return on the best short is actually driven by the high conviction portfolio. Okay. Now,
you have 5 more minutes. Yeah.
Sure. Now there could be additional explanations. So we look for a number of market frictions that have been investigated in the literature. So, for example, we look at short selling risk as measured by the dispersion in the lending fee. We look at search cost. We look at leverage constraint. We look at the scarcity of lendable shares. So I'm gonna skip the results, but we find that none of these frictions can explain our results. Now, alternatively, you might expect that there are a number of frictions that collectively might limit the ability of the stock market to incorporate information into prices. So in this case, we have also tried to relate short conviction to measures of speed of information diffusion. And this speed of information diffusion is typically proxied with the price delay. And high price delay means less efficient stock price. So here, like we summarize the methodology that we borrow from Moskowitz and Boehmer and Wu. So basically, you take returns within a year, you regress on the lag, the stock market return, and then you construct, this measure of price inefficiency, and then you run funny regressions where on the left hand side we have our measure of price delay, and then on the right hand side we have conviction plus additional control factors. And so here we find some mixed evidence in the sense that there are some specification where there is a significant relationship between short conviction and price delay, but there are cases where this relationship is statistically insignificant. So here from this exercise, we conclude that price inefficiency is not necessarily explained or linked to short conviction. You can also see this type of results by looking at like pure descriptive analysis. So we look at the characteristics of our short conviction portfolio. So for example, as you can see from portfolio 5, portfolio 1 to portfolio 1, so there is not much pattern in terms of leverage, in terms of market cap, price to book, profitability, short selling risk, illiquidity, borrowing fee, loan supply. So to some extent, it's very difficult to find a pattern that might explain, the spread between portfolio 5 and portfolio 1. So we also look at the impact of transaction costs. So in this case, we account for the bid-ask spread. It's the red line, or we account for both the bid-ask spread and borrowing fees is the green line, whereas the blue line is the cumulative wealth before transaction costs. And we find that obviously these transaction costs will bite part of the excess return, but the excess return after all these transaction costs will remain positive and statistically different from zero. And as I said before, we also look at a measure of short conviction that you can extract from other investors. We do not find a similar pattern, and this might, to some extent, confirm our hypothesis that we extract information from highly specialized hedge funds, and they collect information, and that's why they tend to bet on few selected stocks. So to sum up, we exploit public disclosure of a net short position. So we believe that this net short position can reveal some valuable information, and we monetize this information through a best short strategy. We fail to explain these excess return using traditional risk factors or other market frictions. We have missed something. This is the one of the first drafts of the paper. So I very much look forward to Ekkehart for his constructive comments. Thank you.
Ekkehart, it's your turn for the discussion. The discussant is Ekkehart Boehmer from Singapore Management University.
I need a minute because I have to get my screen shared.
Yes.
And whenever I touched my Zoom, everything got down. Maybe this time. Okay, so as we saw in the presentation, so there's a very interesting data set that Pasquale and co-authors have. Basically, it's very simple. So you have informed traders out there, and to capture some of the returns, you just mimic what those traders out there, what they are doing. So once you detect them, and you could use for that the conviction scores. But I mean, that is really a secondary issue, what kind the variable is. What is interesting is that we have two important features that the sample has. Okay, so one is that they can use a notification feature. So at some point, the regulatory environment in the EU, I believe it's on the EU, it changed so that short sellers had to notify authorities and private investors when they pass a certain threshold or go on the way down to pass a certain threshold. And so these are great data, and so this is what makes the paper work, because once we can do it on an account basis, then you can actually calculate those scores, for example, and then from there build the very interesting experiment. Now, the alpha was at 7% to 8 or 9%, somewhere in that region. The alpha is actually quite large. And the authors have thrown, I would say, everything probably that came to their mind. And I can imagine referees asking for that. Because in my mind, when you have your 8% return, your 8% alpha, then is it really so interesting that there's yet another, you hear this quite often also, there's yet another variable that can predict returns, that can generate alpha. And so you have to provide more than that. You cannot just come with 7 or 8%. You have to have more than that. And what you need to have is an economic story, in my mind. If you have an economic story, then you can sort of talk to people and try to convince people who have read your paper. Once you have a story, then you can present something that has economic meaning also. And so that was kind of my thought, because it is so nice. I mean, the data set is nice, and then so what is also nice is the other things. And I mean, you can sort of whatever you want to throw at the alpha generation. It is fine. It is good. So I mean, I believe the results. The results are very, very nice. The results are very strong. And so again, the only piece that is missing is that you tell me what exactly is going on. So where do the 7 to 8% come from? Okay. It's a lot of alpha. And so again, I think you have to have some sort of story where you sort of inform people who make the effort to read your paper. Then I think we have to have something that we can respond to somebody who asks a question, for example, 7 to 8%, where does this go and where it comes from? Where does it come from? Okay, now, so it doesn't really help the authors, I believe. I mean, if I come with another, if I had, I don't, but if I come with another alpha generating function, so that's not really the point. So we have enough alpha. We need the explanation that goes through the economic story. And so I would be very happy to give you an economic story, but unfortunately, as you know, they are hard to find and hard to get. So I also clearly, I mean, if I had, I would probably also write a paper if I had a good story on what can generate 7 to 8% alpha. So, so let's look at the paper a little bit more deeply and in more with a little bit more economic story. But keeping in mind that ultimately that's what we want to have. We want to have a very coherent, short, ideally precise type of economic framework, economic argument, whatever works in this direction would probably be good. And so what I would propose is that we look at liquidity. Okay. Why would I look at liquidity to answer this question? Well, 3 points. First, when you look at section 5.1, what you see there is when you have when you deduct transaction costs from your alpha, it becomes smaller. It's perfectly fine. That's what you would expect. So this is one observation that makes some variables such as liquidity look relatively strong, because those magnitudes in the table were actually quite big, not enough to make them independently. So you still have significance in all that. Second observation, figure 6, figure 7. So those are event studies. Event studies that were related to liquidity returns. So there's the cumulative abnormal return. And so those variables also seem to play a pretty strong role, being liquidity related and then helping you a little bit to come up with that story one step more. And so the previous one, what was that? I should have gone the right way. Okay, so let's go here. So why would we think that liquidity plays a key role or should play a key role? I would even say liquidity in this paper must play a key role, otherwise the results don't make sense. Why? Because I have a strategy that has daily turnover. Okay? A strategy with daily turnover, that means that 252 times at most, still at most, has to earn that initial step to begin with. And I don't know how many percent. I don't know the European market. I don't know exactly what they can do there. I don't know if I can do my synthetic replication of the index that I'm actually selling. I mean, there are many ways to save transaction costs. But in this magnitude, it is very large. I don't know what words would be appropriate. So there would be very large costs upfront that the trader has to earn. Okay, and so that alone is a reason to focus very deeply on liquidity. Okay. So at this point, have we learned anything else over what we had when I started complaining? No, I think we haven't really earned much else. So unfortunately there's still the work to do. But let me see. So we know there's alpha. Alpha is around in this paper. We also know that liquidity has got to play a role in this paper. And so that is something that, I mean, what kind of role it is exactly that liquidity plays, that is something for you to find out and document, if you ask me. And then there is a lot there's a lot of room in focusing the paper into that particular direction. And so that's why liquidity is an important economic concept. And so that is why I keep coming back to liquidity. So let me spend 1 more minute or 2 more minutes on something that is more related to the technical details. I mean, not really technical. I'm not a technical person, but I would like to suggest also some things that are important, I think, in making the results more convincing as well. So first, there's a little bit there's not enough understanding for me of the US data, US results, and the European results. The reason for that is that I have never worked with the European results, and I've done some work with the US results, but I cannot say whether there are trivial results in the US that all of a sudden became less trivial in Europe or vice versa. But some of the European results are, without any meaning, but they were different in the US. And so these relationships I like to understand better, because here it is very important that you know how it is important that I know what are the basic strategies. Where do I lose? I mean, do I have to go to 14 markets at the same time in Europe just because they are there? Or do I do I have other strategies when there's stocks around that have a lot of different cross-listed stocks compared to stocks that are not cross-listed anywhere? I would expect to have different strategies in those markets, A versus B. So that is perhaps something to just inform your readers about. Complete the liquidity story. I will email you later the slides, of course. So that, and then understand net short versus overall short. That is something that, you may have seen my JFQA paper where we had the Japanese data corresponding to this, exactly this type of data. So at the same time that Adam Reed and co-authors also had a JFE paper, so there was those.
One more, time's up, 1 more minute, yeah.
I'm about done. And so there's a connection to work that has been done in the US, and the Adam Reed paper doesn't matter. Okay, so he has a paper. Let's stay with that. And I hope the comments are helpful to you. Feel free to contact me, and I will also later email you my slides of your paper. All right, thank you.
Thank you, Ekkehart. Pasquale, you want to respond, and then we have at least 1 or 2 questions.
Yes, thank you very much, Ekkehart. These are all very valid comments. I agree that with you that we need to have a better economic story. So we are aware of that. We are trying to work on that. And yes, on the liquidity, we have done some exercises. Maybe we have to do more, and we'll do. And again, thanks a lot for all your comments. They are all very valid, and we'll try to build on that. Thanks.
There's a question from Roger. It seems more about sorting on magnitude of short sale versus whether the constraint was a short sale constraint or not. So maybe Roger, you can ask the question.
I guess I wonder what's the focus on best short, right? Aren't we just sorting based on magnitude? So magnitude obviously should matter more than the sign, right? So is this just about magnitude versus the sign, or is the relative ranking within a fund matters or something like that?
It's the relative ranking within each fund that matters, because, for example, if you construct, let's say, a similar cross-sectional strategy using total short interest, you find a 0 excess return. We document that in the paper to some extent. So this is basically it's the ranking within each fund, and then you aggregate across all funds.
Okay. Yes. Yeah. I see. Yeah. Thanks.
You're welcome.
Have you Pasquale, have you also looked at whether there are some frictions in terms of capital requirements or funding requirements for the short positions, and if that varies across these markets, and if that could explain the cross-country variation in your predictability?
That's a very good point. No, we have not looked at the basically different capital requirements. I think it's something that we might probably look at. That's a very good point. Thank you. Thank you, Aladdin. Thank you.
Okay, I think we got 1 minute for any last questions. No. So I think we had a great session today, and it was very lively and good presentation and discussions. I wish everybody good luck with the papers, and we will be back. The investment session is next week, so please come back, and there are other sessions going on in the next few days. Okay, please, I guess we cannot clap and everybody here, so maybe we can wave and say thank you to everybody for joining us in this session. Thank you.
Thank you. Thank you very much. Thank you. Bye-bye.
Bye-bye.